Okay, let's unpack this. We've been given access to a proprietary view of the market, and it's coming at a really critical time.
It really is. We're talking December 2025. The year is basically over, and you've got that big FOMC meeting, the Federal Reserve meeting, on December 10th, just looming.
And the source material, it's basically a high-level roadmap. It's designed for one thing, right?
Mm,
Navigating these huge market divergences without what they call an emotional collapse.
exactly. I find that fascinating because they get that success in the market isn't just about one thing. It's not just, reading the news.
Right.
It's about having two pillars. First, a really robust internal system, a framework for how you manage risk and entries. And then you layer the external stuff, the big picture, on top of it.
And they promise a way to predict these major liquidity flows 2, even 3 weeks out.
Yeah.
So that's our mission in this deep dive. We want to give you a shortcut to understanding that whole dual pillar approach. We're going to walk through their internal structure. They call it the 6-week Fed cycle. And then we're going to dissect their ultimate risk map.
Which uses these three key macro indicators to give you a pretty definitive bias for assets like Bitcoin, gold, major currencies.
All leading into the end of the year.
I mean, this whole thing is the definition of trading with a system over just raw emotion. It's designed to answer that core question. How do you structure your strategy so that when the market gives you a really high conviction setup, what they call the pitch,
You're ready to swing.
you are absolutely ready to swing the bat because you know your risk is already defined. It's already managed.
Okay, so let's start with that internal piece, the 6-week Fed cycle. You mentioned it's about structure.
It's pure structure. It governs all your strategy between the scheduled Fed meetings. It acts like a disciplined envelope that tells you how to enter a trade, how to exit.
How to manage the risk.
Exactly. But here's the crucial part. It handles everything except the direction. It doesn't tell you if you should be long or short.
And that's a key distinction.
It's so key because if you're wrong in the direction, the system still protects you. The first step in this cycle is defining what they call the box.
The box. Okay, what is that?
It's surprisingly simple. You're just identifying the absolute highest price and the absolute lowest price an asset hit between the last Fed meeting and the one that's coming up.
And the source gives us a great example with Bitcoin for this period. The range was huge, which I guess illustrates the kind of volatility they need to manage.
Oh, it was massive. A high of 113,643 back on October 29th, and then a low of 80,458.
So why is knowing that cycle low, that 80K number, why is that so critical?
Because that low becomes your foundational line in the sand. It's where the strategic advantage, what they call the 10% rule, really comes into play.
Okay.
If you decide, okay, the direction is up, I want to be long, you can place your stop loss just behind that cycle low, the 80K region for Bitcoin, with extremely high confidence.
High confidence.
Because the source claims that once that cycle low is established, it holds. They have a failure rate of preventing a whipsaw of less than 10%. It's a mechanism built to stop you from getting knocked out by, just some short-term noise.
That gives you a ton of conviction, doesn't it? But I mean, if you're putting your stop all the way down at 80K on a long entry, you're risking a lot of money per trade, right? How do they handle sizing that?
Great question. And that brings us to their three soldiers strategy. It's specifically designed for layering into a strong trend without actually increasing your initial risk unit.
Okay, so let's talk about the R ratio. I think that's central to this.
It is. R just stands for risk. So if you risk, say, $100 on a trade, that's 1 R. If you make $300, you've got a 3R return. Simple as that.
Got it. So with the three soldiers, how do they expand that return without going past that initial 1R of risk?
Okay, so the first soldier is your standard entry. You establish it near that cycle low we talked about, or some other major support zone. That's your initial 1R of risk, your money. But here's the critical part. The second soldier, it's funded entirely by floating profit once the trade starts moving your way.
Ah, so you're not using your own capital anymore.
Exactly. You are now risking the market's money.
Yeah.
Not yours. Then the third soldier is added when you're anticipating a breakout. And again, it's funded by profit.
Wait, hold on. So if I'm getting this right, the real genius here is that if the trend really starts to run, you could have 3 positions open, all protected by that initial 80K cycle low as the main stop.
Yep.
But only that very first position ever risked your actual capital.
Precisely. Your total risk unit never, ever exceeds that initial 1R.
Yeah.
But because you're pyramiding your position based on profit, A standard 2-hour trade can potentially just explode into a 15-hour, 20-hour, or I mean even a 30-hour trade in a really strong trend.
It turns manageable risk into this massive momentum reward.
That's the idea. So that internal process, it defines how they maximize the opportunity.
That makes perfect sense. Okay, so the internal process manages the trade, but it doesn't tell us if Bitcoin is actually going to 120K or if it's going to fall back to 60K.
Right. For direction, we have to look outside.
We transition from the internal process to the external analysis, the ultimate risk map. This is the market's health check.
Yeah, if we connect this to the bigger picture, if the internal process is the disciplined engine, then the risk map is the navigation system. It tells us which way liquidity is flowing around the globe.
And the first barometer they watch, they call it the last functioning smoke alarm.
That would be credit spreads.
What exactly are credit spreads? And, why should someone who isn't trading corporate debt even care about them?
Think of it like the market's resting heart rate. Credit spreads just measure the difference, or the premium, between the yield on a risky corporate bond and the yield on an ultra-safe government bond.
Okay, so like a risk premium.
Exactly. So if a corporate bond yields 4% and a safe government bond yields 3%, the spread is 1%. That 1% is what investors demand to hold the riskier debt.
So how does that translate into a signal, risk on versus risk off?
Okay, so if the spread compresses, let's say it drops from 1% down to 0.5%, it means investors are feeling good. They're comfortable accepting less premium for taking on risk. They're hungry.
Liquidity is healthy?
Liquidity is healthy, and money is flowing into risk assets. That's a huge risk-on signal. It's fantastic for things like Bitcoin and stocks.
And the opposite.
If the spread blows out to, say, 2%, it means fear is spiking. Investors are demanding a huge premium to hold that corporate debt. That signals risk off.
And for December 2025, what was the diagnosis?
The spreads were coming down. The smoke alarm was quiet. It was indicating healthy, abundant liquidity. And this correlated perfectly with Bitcoin's move up into that 92 to 93K region. The credit spread gave a green light.
Okay, so that's the first one. Let's move to the second indicator, what they call the cocktail mix.
Right. Real yields and the dollar.
Real yields are basically what you actually get paid on a U.S. bond after inflation has eaten away at its value. The source cited a critical ceiling here of 1.9%.
And we care about real yields because they are the ultimate competition for risk assets like stocks or crypto. I mean, think about it. If you can get a guaranteed, attractive real return from a government bond.
Why would you risk your capital in Bitcoin?
Exactly. But if the real yield is negative or just really, really low, capital is forced out of safety and it has to go hunt for growth.
So what's this magical cocktail they're looking for that sends risk assets flying?
It's a mix of 3 ingredients. You need real yields trending down in, the dollar usually measured by the DXY index also trending down, and the S&P 500 trending UP.
Okay.
When you see real yields drop below that 1.9% ceiling and the dollar softens, it's a huge signal that capital is fleeing the U.S. Treasury market and it's looking for higher returns elsewhere.
And the current status, is that risky cocktail being served?
Oh, absolutely.
Right.
Real yields were firmly trending down below that 1.9% ceiling and the dollar was softening. This creates a really powerful bullish bias.
And they contrast that with the real fear scenario.
Right, which happened back in, I think it was March or April of 2025. You saw real yields drop, but the S&P 500 dropped too. And when both safety, bonds and growth stocks are selling off at the same time, that's when you get true panic in this system. We are not there. We are seeing a positive rotation.
Okay, that clarifies the liquidity picture. Now, the third piece of the risk map, this one targets the consumer directly. The XLP-XLY ratio.
Yeah, we're talking consumer staples, things you buy when you're worried, like toilet paper or groceries.
Survival goods.
Right, versus consumer discretionary items, the nice-to-haves.
Yeah.
New cars, electronics.
So how does the ratio of these two give us a signal?
So the ratio compares the two sectors. And the key insight here is that this ratio is inversely correlated to the S&P 500.
Meaning if one goes up, the other goes down.
Exactly. So if the ratio goes down, it means money is rotating out of staples, the XLP, and into discretionary, the XLY. And that signals high consumer confidence. People are comfortable enough to spend on non-essential stuff.
Which is pretty much the clear sign of a strong bull market you can get.
Pretty much.
So let's put it all together. The 3 barometers. Credit spreads are dropping. You've got the positive real yield and dollar mix. And the XLP-XLY ratio is moving lower. The macro environment is just unequivocally signaling risk on.
The external analysis provides the directional bias. So it's risk on. Now we can take that bias and plug it back into our internal structure.
The 6-week Fed cycle.
To target specific assets.
Okay, let's start with Bitcoin. The outlook is bullish, confirmed by the macro, so the strategy becomes pretty simple, right? Defense and offense are defined by the cycle.
Precisely. For Bitcoin, that 80K region, the previous 6-week Fed cycle low, that becomes the critical line in the sand. As long as Bitcoin holds above that 80K zone, the probability for an upside breakout just remains dominant.
So the strategy is targeting moves beyond 90K, pushing higher.
It is. You have this confluence of a disciplined entry system combined with favorable macro signals. That makes it a really high conviction trade.
Now let's shift to gold. It has this sort of perpetual safe haven status, but the source also identifies some really powerful and unique catalysts.
Yeah, with gold, they were already holding longs from much lower levels, which reflects its ongoing bullish undertone. But they were looking for a more tactical entry. The ideal setup for the next leg up was a pullback, maybe toward the 3,900 price level.
And this is where the analysis got really specific about timing. They point to this powerful seasonal driver, which they enthusiastically called the January effect.
Yeah, and the data on this is, it's pretty compelling. Historically, January is bullish for gold 8 out of 10 times.
8 out of 10, wow.
It's an almost automatic bid. It's due to all these different global factors just resetting at the turn of the year. They weren't shy about it. They called this, and I quote, shooting fish in a barrel, which implies a very high probability setup.
And then stacked right on top of that seasonal effect is a political catalyst they flagged.
Yes, the high probability of a U.S. government shutdown at the end of January.
Which creates uncertainty.
A government shutdown, or really any significant political uncertainty, it spooks investors immediately. It sends capital scrambling for safety. And for gold, they see this as an automatic bid.
So you have seasonal strength plus political risk on top of an already supportive macro environment.
All of it converging on January. That's a massive signal for gold.
Okay, finally, let's look at foreign exchange, specifically USD CAD and this broader theme of dollar softness. The analysis here is strongly bearish on the US dollar versus the Canadian dollar.
It is, and this bearish idea for USD CAD actually started way back in February when the pair was trading up near 1.44.
So what was the original argument?
The fundamental case was that geopolitical friction, especially the threat and implementation of tariffs under the Trump administration, would ultimately hurt the U.S. economy and its global trade standing more than it would hurt Canada's.
Okay, so that's a long-term macro view. What's the actionable trade plan now, almost a year later?
The plan is still to be shorting it. They anticipate a continued decline of the U.S. dollar. So they advised shorting any pullbacks into the 1.4 to 1.480 zone.
And the target?
Targeting 1.39 as the next near-term floor, with an eventual target of 1.37 sometime next year.
And they use the Chinese yuan as kind of an anchor for this whole FX story, the USD-CNH cross. Why is the yuan leading the narrative?
Well, because the yuan often reflects global trade balances and capital flows in a way that the DXY index doesn't always fully capture. And since the USD-CNH broke lower, confirming that bearish trend for the U.S. dollar, it suggested a broad risk-on environment.
Which supports their other calls.
It supports everything else. And it also supports their prediction that the USD pair is likely headed towards the 1.20 level next year. So the dollar softening theme, it's global.
Okay, let's bring this all back home for you, the listener. We've taken apart the internal system, the external map. What's the single central takeaway from all this?
The central takeaway for the end of 2025 and heading into 2026 is that liquidity conditions are overwhelmingly loosening. The combination of falling credit spreads and that positive cocktail mix means we are currently in a buy-the-dip regime.
So the ultimate indicator to keep an eye on then is that real yields versus DXY correlation.
Absolutely. As long as real yields stay suppressed, staying under that 1.9% ceiling, and the dollar continues to soften, money will be forced into risk assets. The whole goal of this analysis is to show you how a structured process like the 6-week Fed cycle, when you combine it with clear, objective macro signals, provides those high-confidence zones.
It lets you establish scalable risk without relying on fear or greed.
Exactly, right when it matters most.
So what does this all mean? The source material, it successfully identifies these powerful seasonal and domestic political catalysts like gold's January effect and the potential U.S. government shutdown as, guaranteed triggers for safe haven moves. But that original bearish thesis on USD CAD, that came from wider geopolitical trade tensions, specifically tariffs. So with that in mind, and the strong prediction of an automatic bid for gold during a domestic shutdown, What other major non-economic geopolitical flashpoints out there, whether they're military, supply chain, trade disputes, what else might suddenly materialize and create a sharp systemic reversal? A reversal that leads to an unexpected automatic bid for safe havens, even if the current risk map is signaling all clear.
A black swan.
It's a reminder that even the best systems, they need constant scrutiny for those black swans that are always lurking just outside the model.